says, saw the video on ratio spreads and would like to know the proper short-long setup. Okay, proper short-long setup. The reason is that on TOS platform, they default to 2 shorts OTM and another 1 long further OTM. I've seen the opposite on most other examples, which requires less margin. Please explain. Okay, so let me just read that again. They default to 2 shorts out of the money and 1 long further out of the money. Okay, so let's just go to the custom spread tool. In the video, I used SPY, Dana, so I'm going to stick with SPY here. All right. Now, we're also going to go to May 15th because that's the same example I used in the video that was posted today. So we'll use the May 15th expiration date. Now, let's take just a ratio put. They say, let's see, we're at 248, right? Okay, so they say that you're saying TOS uses one where they sell 2 out of the money and buy 1 further out of the money. The idea is you still want to get a credit if possible. So let's say I went, we'll keep it even. We're at 248, so let's go about 13 points out of the money on a put spread, ratio put spread. We'll sell 2, I'm sorry, we'll buy 1. Yeah, I'm confusing myself, sorry. We'll set up the structure where we'll buy a 9, you wanted to sell, I'm sorry, let me read yours again. You mentioned it different. It sounds like a back spread almost is what you're talking about. I'm sorry. They default to 2 shorts out of the money and 1 long further. Okay, so selling here, and then let's buy the 225. Okay, so we're selling 2 out of the money puts and buying 2 further out of the money with a 10-point strike difference. 2. Oh, sorry, folks, buy 1. When it's a straight ratio put spread, there we go. And it sort of gives us this structure. Now we do end up with a naked put position, as we would with any. Whenever I sell 2 and buy 1, I've got a 235 naked put combined with sort of a bull put credit spread with a $2 net credit. Okay, so we do take in a credit of 1123, but we have to put up the margin here in this case, 24,500. Okay, so now what? You went on to say, I have seen the opposite on most other examples which requires less margin. Please explain. Okay. I think what you're talking about is the 2 different spreads I mentioned. I'm not sure this is where you're asking of them being out of the money and in the money versus that range. Where I'm going with this, Dana, is that this one here requires a huge margin, as would any standard ratio spread, because you end up with a naked position. If I did this with calls, the ratio spread you saw in the webinar, one of these is naked. That requires the highest margin, $24,000. I have to cover, A, the spread of the bull put credit spread. Okay, buying a 225 put and selling a 235 is an out-of-the-money bull put credit spread, so I have to put up that 10 points. But I also have to put up the naked put margin, which to be cash secured would be $23,500. That's why we see the $24,500 monetary requirement to cover the full amount for the cash secured put, which is naked, and at the same time, the 10 points on the bull put credit spread. Now, a different way of doing it, what we showed in the webinar, is that I'd buy a different spread. There's 2 ways to go about this. What we showed with the spread, the ratio spread, I'm sorry, in the webinars, I might be buying an at or slightly in the money put. Sorry for the scrolling, has to be done. Okay, so let's say we go with the 250. I'm going to buy the slightly in the money one. I'm actually going to buy the higher strike put, not the lower strike put, because then I have to cover the bull put credit spread and the naked put. And let's go 240. Let's keep it a 10-point spread, but we'll go with the 240. So what am I going to do here? I'm going to sell 2 out of the money puts at the lower strike and buy the higher strike put. But I'm going to get $22, 1130 times 2, 1125 times 2 for the 240s. I'm going to pay about $14.90 for the long. So we're still going to get a credit. buying one of the higher strike puts, the at or in the money put, and selling two out of the money puts to get a better net credit, this margin is still going to be around 240, okay? But there's no extra monetary requirement. Why? Because in this example, slightly different. This is the ratio spread that we normally talk about as a true ratio, the standard ratio spread. I bought the 250 put, which is in the money, and sold two 240. So what do I have? I have a bear put debit spread. That 240 put obligation is covered by the deeper in the money. In your example, we looked at something where we sold the 235s and bought a 225 deeper out of the money put, which means what? Now I've got a bull put credit spread where I have to cover the margin for 10 points plus the margin requirement here. Now, interestingly enough, it was only $500 more. This ratio spread, true ratio spread here, still have to cover that naked option, which is $24,000 if I was cash secured. You might be using a percentage, okay? But I don't have to cover the bull put credit spread extra margin because I'm in the bear put debit in this case by buying that higher strike. So it's a tale of two different things. Now, honestly, both of them we saw would be kind of bullish positions. Your position sort of did this, and then, I'm sorry, it was a little bit higher, I apologize, but at 235 it sort of did that, skewed off there. Both are bullish positions when using puts, and if we use calls, they'd both be bearish positions. But the margin discussion that you're having is because in the way that you talked about it, where they said selling the two deep out of the money and buying one further out of the money, that type of ratio spread creates a credit spread in the construct where you have to cover the difference in strike prices in that setup plus the strike price of the remaining naked option. When done the other way by buying the in the money higher price and selling two lower to get the net credit, which is still pretty good, I don't have to cover that extra margin, but I still have to cover the naked strike. And then, of course, if you did the ratio back spread we talked about, there is no margin requirement essentially. Well, there's a small one, but that's the one where you have the valley there where I'm actually buying two and selling one. So I have to cover the margin of the bull put, but there's no naked option. So this would only be 10 points or 20 points, you know, so maybe $1,000 to $2,000 rather than $24,000 in this example. I hope that's clear. It's a little bit different way of looking at it in that sense. And in both situations that you were talking about, both of them have a naked option, but when you use that other structure by buying the lower strike put or the lower strike call, in that case, then we're going to end up having to cover the margin of a credit spread, where in this structure, it's a debit spread. You don't have to cover the extra margin. Okay. Now let's see some comments on that. In this case, as Sam mentions on this, is that I don't think this is a good structure because the market goes lower, you lose on both positions, and risk alignment, market will go more lower with the fear of the more spread. Now this is true, but this, remember, is the put ratio spread. The put ratio spread in this case, I'm not saying bullish or bearish, I'm just using the structure, but that's the standard put ratio spread. Dean had mentioned that TOS talks about it a different way, where they're using more out of the money, which is an advantage in some cases because you don't risk the case of early assignment. It's further out of the money. It's got to go further down. But again, we talked in the webinar I posted. We talked about it last week, Sam, and you saw it, I think, live, but we didn't. I had to manually do the recording. We posted that today. If I was bearish, I might use that structure with the ratio call spread. Again, sell two out of the money, and let's just go to 240. What's the 240 price? Yeah, it's pretty good. We'll keep the same 10 points, but reverse it. I'm going to sell two out of the money 250 calls and buy an in the money 240. And I'm going to explain, there's another comment that came in here, and I'm going to explain it all in just 1 minute. All right, so here's the call spread, which is more of a bearish play. It takes infinite risk to the upside, which I don't like. By the way, with the naked put position, we know that most of us can do cash secured naked puts on level 2 trading depending on your broker. And you might get a percentage, meaning only have to put up a half or some percentage of the naked put requirement if you're on level 3. In order to do this ratio call spread, you have to be level 4 trading, Why? Because again, I'm in two different constructs. I'm in a, not that, I'm sorry folks. We're in a bull call debit spread, so no extra monetary requirement, and the naked call position. One of these calls is naked, which I can't do unless I'm on level 4 approval with my broker, okay? So they won't even allow that. That's still naked. Now, I can do it as a stock repair when I use this ratio spread. I'm going to get to that in a moment. I do use this ratio spread for two reasons. If I own the stock. This goes to Bernard's question. He says, what circumstances would lead you to consider a ratio spread? And, okay, the ratio spread is one combo trade or add additional shorts to existing vertical or even a covered call, okay? This is what I covered in that webinar. So you haven't seen it yet, Bernard, and I don't want to spend too much time reviewing it because it is in the webinar as well. I will use this ratio spread as two functions. One, as an income method number 5 in the blueprint. This is the ratio call spread. So if I own stock or if it's in a married put, using this doesn't give me anything naked. It's a covered call with a bull call debit spread. Now, I don't know if it's going to get me to break even. Here we are at 248. But there's also, this is used in what's called the stock repair. Let's say I owned shares of SPY, Bernard, at $2,650, at $265. Okay, it's now trading at 248, so I'm down a fair amount here, $17. Let's run that. I'm not going to get to break even. Oh, I did. Look at this. On Power Options, Bernard, we have a stock repair tool. The stock repair tool tries to build ratio spreads for your position. You can put in your stock price and the number of shares, and it tries to build a ratio spread to help you get back to break even faster. Look at this. If the stock goes back up to 250 at May expiration, I'm at profit. Even though my cost based on the stock, Bernard, is still $265. Where's the extra $15 come from? That $700 net credit that we got from the ratio spread, and if the stock's trading at 250, what happens? The stock, let's say it's at 252. The stock gets assigned, and I get 10 points back for my 240, 250 call spread. So we get 10 points on that bull call debit spread if the stock's trading at 250. I keep the $7 net credit, roughly, that we got here, and that's the $17 I'm missing plus a little bit more if the stock is only trading at 250 and my cost basis was 265. In the context of a married put, Bernard, or as a stock repair position, that is the only time I use this combination of a ratio call spread. The only time ever that I will use it. Or I won't even use the put spread in that case. Now, in that other webinar, we also talk about the back spreads. Okay, what's the back spread? I just showed one a moment ago. I showed you sort of what it looked like, but let's go back up here. And I'd want to use a put back spread. Sorry, we're going to have to go through scrolling again, so let's get our options up here. Let's go back to May 15th. Now, what I'm going to do in the ratio back spread is I might buy, this is where, Sam, your other comment comes in, the risk of assignment. I might buy a slightly when I did the webinar, we had to go very, very wide. And I think I had to go, did I do 250 and 280? No, I did 240. So it's $22. Yeah, you see the problem. Need $22. Let's make it worth our while. We'll go to 270. Okay, so this is a 30-point spread. What I'm going to do here, Bernard, is the opposite. Remember, I'm using puts. I'm going to buy 2 of the lower strikes in a back spread and sell 1 of the higher strike. Now, because of implied volatility, the only spreads I saw on this were 20 or 30 points apart when we were setting up the webinar. That's really too far for me, but let's talk about why. Here's my margin requirement on the back spread, $3,000. Why? And this is just one contract. Because I sold an in-the-money 270 put and bought an out-of-the-money 240, which is an out-of-the-money bull put credit spread of 30 points. I have to cover that margin. Okay? But what we like about the ratio back spread as a potential, Bernard, as another means of having another tool potentially to act as a market hedge. Ratio back spread, put ratio back spread on SPY, QQQ, IWM, maybe even SPX or NDX. Why? If I just buy SPY puts at 250, as we talked about earlier with James, I have a loss here and it starts to go and I start to get a profit. I'm hedging my portfolio with SPY. Let's say we're at the 250, 240 strike. But if the stock goes the opposite direction, the market goes the opposite direction, I will take the 100% loss on my long put. It can go to 0. But with this put ratio back spread, if the market recovers and starts to move back up, if it does that and all my puts expire worthless, I get $295. Instead of a full loss on my long put, I get a little bit of profit. Now the break even is tough. This isn't down to 212, so you see how extreme you'd need this to move in order to start profiting. Whereas if I bought the 250 put for say $12, I just need the stock to drop to 238 for my break even, not 212. Right? So it's a much wider movement. And we can structure this using maybe further in the money puts or further out of the money, but then it skews that lower break even. Here's the real rub, and this is what Sam mentioned. He says the risk of assignment. Here's the catch, and this is talked about in that webinar as well, Bernard. So in this case, if I sold the 270 put and I've got my 240s here for my ratio put spread as a market hedge, which probably would have worked well at the end of February, middle of February, right? If I was buying March or April options. But let's not do that. What's wrong here? I'm short this option. I can be assigned at any time. Okay? Now my puts are at 240. Let's say the stock stays right around 250. SPY stays right around 250. I'm assigned at 270. Sure, I have these puts to cover this, but I can't exercise the 240 puts if the market's trading at 250. What would happen? I'd have to buy shares of SPY, of course, at that price, at 270. So I'd have to have the $27,000 available in capital for one contract. We did 3 contracts. We're up to what? 71,000? 81,000, I'm sorry. So you see how fast that balloons up. Now, sure, you could just turn around and sell it at the market if it happened intraday, sell it for 250. You didn't have to have that whole capital up there, but that's a risk of doing this strategy. The best structures, which give you the best possibility for an upper or lower break even, are going to entail selling the in-the-money put and buying 2 slightly lower, or selling a deeper in the money and buying 2 slightly in the money if you can get a credit, which is hard to come by, especially now in implied volatility. We're having to go 20, 30 points apart, which does mean a much higher margin requirement in that case. So Bernard, that is, in that case, that is the only time. And you say, Sam says, why sell puts, just buy it. This is the sort of the discussion on that is, you're right. If you expected a market decline and the prices weren't that bad, you'd probably get a better break even, as I mentioned, Sam, and that's why I'd probably lean towards that instead of selling the puts and creating this structure. But this structure does give us a little benefit that if we're wrong, we still make a profit, not a full loss. But we do increase this break even by a lot, so it could be pretty tricky in that scenario. Okay? But again, Bernard, the only times I would use a true ratio call spread are in the context of owning the stock as a stock repair, or as possibly that income method number 5 in a married put. The only time I'd use this ratio put back spread is as a market hedge on a broad-based index ETF or maybe a contra ETF as well. Okay. Mike adds a comment here. Mike W says, can the IV become too high to do a decent put ratio back spread? Yeah, I think we're there. This is still showing me good numbers, Mike. As far as getting a credit, I don't like this 30-point spread. On SPY in September, we had that little hiccup in August, remember, but back to the good old days. September and into October, I could probably do a 5-point spread with this ratio put spread and get a credit because the IV was at 0.17, 0.14. The IVs are at 0.44, 0.30. We're 3 times to 4 times the implied volatility that we normally see on SPY. Does that mean that all structures, all underlying stocks, the IV is too high to do a decent put ratio back spread? I'm not saying that. I'm just saying that we know that all implied volatilities are 3 or 4 times high. What that means is that we have to go to wider strike differences than we normally would have several months ago, and that means wider upper to lower break-evens. Bigger moves needed, okay? Okay, so, all right, let's see here. Okay. Oh, Bernard says, thanks, Mike. I'm doing some of this, but I forget the lingo from time to time and rationale. Better for me to go back to do some of the webinars, which I've watched too a long time ago. Sure, but just go to YouTube. It's actually not on Power Options right now, Bernard. Go to YouTube, and the first newest video on the Power Options YouTube is going to be that one which I called Introduction to Ratio Spreads. And it's about the same discussion we just had. I might not post this one as well, but we'll see in that case, okay? All right, so Dana's follow-up comment was that makes sense. Wonder why TIS has it set up the more expensive way. I think it's for the same thing that Sam mentioned, and that's for assignment. When you talked about the example that I showed you with the ratio spread, we were selling near the money, and in this put ratio back spread, I'm selling it in the money, which TOS knows you're running the risk of being assigned at any time at that short call or that short put strike price if you use an at or in the money structure. I'm going to say, even though that margin requirement is added, Dana, that theirs going out of the money in that fashion is a little bit safer in the sense of not getting assigned early, a lower probability of getting assigned early. I'll say that. That's a benefit of that structure they're showing you. But to get one thing, you have to give up another. And in this case, you're getting a higher margin to give up that high probability of being assigned early. Okay. All right. Harry S. Your question is next. Oh, okay. I'm sorry. I didn't see this ahead of time, Harry, but we just went ahead and did that. Harry's question was, interested in ratio back spreads, how to set up and what conditions are they best used? Okay. So in my opinion, you can see right here, this is the put ratio back spread, Harry. And as I mentioned, I like to use this. If I use this, it's likely going to be on SPY, QQQ, NDX, IWM, a broad-based ETF, maybe on gold, something along those lines, if I'm concerned about a market decline. And to be honest with you, even though I don't like this structure and it's too wide, everything we talked about implied volatility, I'd probably be more apt to use this now. If Sam doesn't think it's the best idea in this case, because my favorite market hedge, buying VIX calls, I can't use right now. So I'm following some of Sam's ideas and concepts about buying UVXY, shares of an ETF, to play around with the movements in the volatility, to use as not only a hedge, but also to make profit. I can't use VIX calls right now, and I'm not going to do a bull put, bear call, bear put debit, or bull call debit on VIX right now because it could be too wild of a fluctuation in one day, could wipe out that trade completely. So this is one way to use it. Now, if you were bullish, of course, you could consider the ratio call spread, the call ratio back spread, which you'd have similar thing. You've got the line here, the dip, and then that's your bullish move. Okay, if you want to see a recovery, try to find a credit here. But what it does mean is you're probably going to be selling an in-the-money call and buying to out the money, which would be a bear call credit spread with an extra long call. So you'll have to cover the margin requirement there as well. Okay. Now you can set them up at different strikes, but what does that mean? Well, if I used out of the money calls, I might not get a credit, but then my upper break even would be really high. So if I, did a 300, bought two 300s and maybe sold a 280, we might see a similar profit and loss chart. But where's my upper break even? It's going to be around 340, 330. I need a much stronger move to profit if you're using out of the money. That's why I like to focus around the at the money positions for the call ratio back spread and the put ratio back spread, usually selling an at or in the money, buying to out of the monies for a credit. Okay. The obvious question here, the next follow-up question, perfect question for Fernando. It's the right question to ask. I just don't really have a great answer for you. I'm going to save that for a different webinar to follow up the last one we did. But you said, what are the adjustments if the price stays in the valley? What's hurting you the most if the price stays in the valley? It's these long options. How would you adjust a long option that's not working out for you? Okay. So what's happening here? I need this to go down. It's not going down. In fact, the market's moving up. Well, it's still going to a good range here, but if I'm just bouncing in this valley, I could maybe sell another one. I could maybe create a butterfly, Fernando. But what do I have to address? I have to address the long. It's not the short that's hurting me. It's the longs that are hurting me. So just as you might adjust a long put or a means that you might adjust a long put, selling another put here, converting it to now a bull put credit spread combined with a bear put debit spread, which would create a butterfly position, might help lower the loss, but will unlikely get you back to break even. Okay. It requires a little bit more movement in that case because you've already invested into the ownership of those two options. And as you start managing them, you might actually increase the risk on the position. It's kind of tricky in this case, the opposite of trying to manage a short butterfly.